Provisions, the guilty conscience of the balance sheet. If prudence is the attitude of being a pessimist, provisions are the actual dollar amounts we write down to fund that pessimism. This is where we take real profits and lock them in a cage because we think we might have screwed up. Grab a stress ball. We are about to discuss how to pay for disasters that have not even sent you the bill yet. In the real world, you do not pay a bill until it arrives. If someone says, "Hey, I might sue you next year," you do not typically write them a check right then and there. You say, "Bring it on," and you keep your money. But in accounting, we surrender immediately. A provision forces you to look at your beautiful profit and say, "You know what? I bet we are going to lose that lawsuit. And I bet those warranties we sold are going to blow up in our faces. Let's subtract $1 million from our profit right now, just to be safe." It feels like admitting defeat. It feels like taking a penalty kick against your own team. Why are we voluntarily reducing our earnings for a guess? It makes you want to shake the auditor and shout, "Show me the invoice. No invoice, no expense." Let's imagine you are the parent of a teenager named Kyle. Kyle has just borrowed your car. Kyle is not a good driver. Kyle has a history of backing into mailboxes and scratching bumpers. Kyle drives off. He hasn't crashed yet, but you are a realist. You look at your bank account. You have $5,000. The delusion. You think, "I have $5,000 to spend on a vacation." The reality. You know Kyle. You know the laws of physics. You know that car is coming back with a dent. So you mentally provide $1,000 for repairs. You don't have the bill yet. The crash has not even happened, or maybe it just happened and Kyle has not called yet, but you know it's coming. If you spend that $1,000 on a vacation when Kyle inevitably returns with a hanging bumper, you will be bankrupt. A provision is just you being honest about the cost of having Kyle in your life. The over-caffeinated lawyers realized that companies love to ignore looming disasters until it's too late, so they created strict rules. You must record a provision if 3 things are true. Think of it as the triangle of doom. 1. The present obligation. You have a duty now because of something that happened in the past. For example, you already sold the defective cars. You cannot unsell them. 2. Probable outflow. It is more likely than not that you will have to pay up. 3. Reliable estimate. You can make a decent guess at the number. If you hit all 3, you must book the expense now. You cannot wait for the lawsuit to end. You cannot wait for the customer to return the broken product. Why? Because the event that caused the cost happened this year, so the cost belongs to this year. We are matching the crime to the punishment. If it is possible but not probable, we call it a contingent liability. We do not book the cash, but we write a scary note in the back of the financial statements to warn investors. Here's the takeaway. A provision is not a savings account. It's an admission of guilt. It stops CEOs from selling terrible products, collecting big bonuses on the sales, and then quitting before the warranty claims roll in.